Hello everybody, it's Chuck Carnevale, co-founder FastGraphs, aka Mr. Valuation. This video here, it's really a sister or companion video to the last video I did where I talked about constructing a portfolio by finding good value stocks even in this overheated market. And in the comment section of that video, I got a question from a subscriber that goes by HeroDex. And they said, "Dear Chuck, I don't know if it directly connects to FastGraphs, but would you be willing to talk about correct position signing of stocks in a future video? Thanks, and great video as always." Well, thanks for the kind words, HeroDex, first of all. And I'm assuming when you ask me about sizing, you're talking about what percentage of each stock ought to be put into a portfolio, how many stocks you might own in a portfolio, whether you should overweight them or equal weight them, and so on and so forth. So I'm going to go ahead and do a video on that. This video is dedicated to using your imagination to build an investment portfolio, a common stock portfolio that's just right for you. A portfolio that meets your own personal, unique goals, objectives, and most importantly, risk tolerances. And here's the most probably important part of this message that I want to share with you. Number one, there is no such thing as the right answer to that question. There is no such thing as one size fits all, or there is no such thing as the perfectly built portfolio. It really comes down to all the unique attributes that I already mentioned. And probably the most important one might be your risk tolerances. Some people are willing to absorb more risk than others. Some people can't stand any risk at all. And so when you're constructing a portfolio, I think you ought to be applying the common sense test. And it's been said that common sense isn't so common anymore. But what I really have found is that people sometimes just get too technical in their approach to this kind of thing. What I'm going to share with you here is going to be totally hypothetical, and I want to emphasize that on the onset. It's unrealistic from the point of view that I've cherry-picked some names here, and I've created a back test. But what I'm doing here is I want to give you something to think about. In other words, what kind of thoughts should you approach? How would I construct a portfolio that met my own goals and needs when you were doing it? And again, it really comes down to common sense and, trying to make sure you understand who you are as an investor and what kind of investor you really are. So let's go ahead and get into it. And let me talk about some different methodologies that can be applied. For starters, there would be the traditional portfolio. I've called it the sample account here. And what I've got is a portfolio comprised of 25 names. The idea would be that you would put an equal amount of money in 25 names and fully diversify your portfolio with no more than 4% allocated to any one name. That way, if one of those companies were, forbid, go bankrupt, you would only lose 4% of your money. If one of those companies lost half the money, you'd only be exposing 2%. And the other 24 names could actually, be moving up strongly and move you into positive territory. So that would be your traditional portfolio. Now, some people would be more comfortable with 50 names. Some people would be more comfortable with a smaller number. Now, there have been numerous studies out recently that have indicated that once you get past 16 stocks in a portfolio, that you use up almost all the benefit that diversification actually offers you. And so, in the immortal words of Peter Lynch, who in his best-selling book, One Up on Wall Street, coined the phrase diversification. Of course, Peter was one to say anything about that. He had, I think, a couple thousand stocks in his Fidelity Magellan portfolio. But the point is, you can over-diversify a portfolio as well. But what really comes down to is how much risk can you tolerate? So, you could build a portfolio that's concentrated, which I happen to prefer. I like 10 or 20 stocks at the most in a portfolio. Some people like 25. I've built portfolios for clients who required 35 or more. I know people that have had 150 stocks in their portfolio. Now, here's a problem with that. Common sense again, applying common sense. If I've got 10 stocks in a portfolio, I'm putting all my eggs in 10 baskets, but I can watch those 10 baskets very closely. If I have 150 or 200 stocks in a portfolio, it's really impossible to keep track of everything that could be going on that would affect the investment results of all those stocks. So, I've always said knowledge is power. If you have a concentrated portfolio of stocks, you actually can learn a great deal about those companies, and you can do what I like to always recommend, and that is mind your own businesses. In other words, pay attention to the things you own and quit worrying about the market, because the other underlying theme of my previous video was it's a market of stocks and not a stock market. Now, that applies, in that first video, I was applying that primarily to valuation, indicating that, there were stocks that were overvalued in this great bull market, but there were also stocks that were undervalued. And I showed you some examples of that. Well, you also have different types of companies making up this thing called the stock market. You have some very fast-growing stocks. You have some stocks that are going bankrupt. You have stocks that have been very cyclical over their histories. You have stocks that have been steady, consistent, powerful growers. So the point is, it is a market of stocks. Stocks are as different as people are. And therefore, you can construct a portfolio to meet your own goals and objectives by simply applying your imagination and having a real clear understanding of who you are as an investor. And I think that's very important. So what I did here to illustrate this, and I'm going to emphasize this again. I've said it once already. I'm going to emphasize it again. What I'm about to show you is totally unrealistic. I'm using 2020 hindsight here. I've cherry-picked a group of names, and I've compared it to investing in the S&P 500. I want to be clear. All I'm trying to do is give you the impact, I'm being melodramatic, if you will, of how portfolio creation can be accomplished and what the results can be. So let's just assume that we had a $2 million portfolio to invest, okay? And let's assume that we took $1 million or half of that portfolio and we invested it in 5 of our favorite growth stocks. Now, again, I cherry-picked these. These are all companies that have had a great record over the last decade. I'm going to measure that for the last 10 years. And, as I did here, and what I want you to see is the earnings growth rate of these companies. The S&P has grown earnings at around 10.19%. The other half, your other $1 million, I'm assuming you just put it in the 500 stocks in the S&P 500. And then, so you'd put $1 million in the S&P and then $200,000 each in these 5 fast growth stocks with these high rates of growth. And then the idea would be, what would that turn out to look like? And again, this is a heavily concentrated portfolio. I have actually built portfolios where I've taken my 10 best stocks and put half the money in it, and then 10 stocks and put it into maybe 50 or 100 stocks, not necessarily an index, but you could also just as easily do it with the index. And it's going to be the simplest way for me to illustrate the power of this by going through this with you. So let's look at the S&P 500. Now, I want to make another point. Virtually every stock I'm going to show you here, including the S&P 500, I consider overvalued. So we're measuring performance at an optimum time. We're measuring it during a bull market, and we're measuring it at a time when the valuations have actually gotten very high. So it couldn't be a better time to be calculating the performance, all right? So let's go back in time now. Let's look at December 31st, 2010. So what I'm really looking at here is the last decade. I'm going to go from 12/31/2009 to Friday's closing price. And if you'd invested $1 million in the S&P 500 over this decade, that $1 million would have grown to $4 million plus dollars. Okay, so in other words, if you were looking at this as your $2 million portfolio, had you invested the $2 million, of course, it would have been worth $8. But the point is, by investing half of your money in the index, you actually would have quadrupled that money, but you'd have doubled your original $2 million investment. I just want to be clear about that. But now let's look at the 5 growth stocks. Again, cherry-picked. So if I took those 5 growth stocks and used comparable time frames here, I'm not going to be precise with this video because it's too hard to do. I would have turned $200,000 original investment, or 1/5 of my million, into over $3.5 million. And if I go right down the line, if I'd have gone to 10-cent holdings here and did the same calculations, I'd have turned $200,000 into about $3.7 million. And if I go into my Netflix and use a very similar characteristics, I'd have turned $200,000 into $4 million, over $4 million. And then if I went into Trex, in home building materials, and again, look at the overvaluation of these stocks, I'd have turned into over $6 million. And then, of course, last but not least, if I'd have gone into lithium motors, I'd have turned into just about $5.5 or $6 million. So the point is that by constructing this portfolio creatively, taking half of my money and putting it into 5 of the fastest growing stocks I could identify, versus putting 100% of my money in the index, or put half the money in the index, half the money in these 5 stocks, I get all the benefit of this massive diversification, but I also get the opportunity to generate significantly better rates of return. So let's recap what we did here. We took a $2 million portfolio, back in the beginning of 2011, end of 2010. We invested $1 million in the S&P 500, or half of that money. We took the other $1 million and put $200,000 each into these 5 really super growth stocks that I talked about. Now, the results, if I look at that over time, the $2 million I invested, the $1 million in the market grew to $4 million. That gave me double my $2 million investment. But then these 5 growth stocks with only $200,000 invested each created all of these fabulous numbers. That portfolio of 5 stocks would have taken essentially $1 million and grew it to $25 million. So the point is, what I had here was a whole bunch of diversification to try to mitigate as much risk as I can, but I yet also had a significant amount of concentration that allowed me to kind of swing for the home run ball. It's kind of like building a baseball team. You know, you do want to have a lot of just guys that can get singles and doubles, and then, you know, you want to have guys that can clean up with the home run ball, but the home run hitters normally strike out more than the guys that, you know, can get on base, the 300 plus hitters. And it's kind of building a portfolio conceptually. But the point is, you know, had you done this, had you taken your $2 million portfolio, say you had worked all your life to build it and you were getting ready, you know, to retire as an example, and you said, okay, I could diversify. I could put half my money in an index and really get 500 stocks and a bunch of diversification. Then I could take the other 5 stocks and take a great deal of risk. Now, the key is you're taking a great deal of risk by investing in those 5 stocks, but you're reducing that risk dramatically by splitting half the money into an index. So the bottom line is you ended up with, you know, $21 million, turned $2 million into $21 million total by investing, you know, splitting it up like this, where if you'd invested all of the money in the 5 growth stocks, you'd have had $42 million. So, you know, the moral of the story is that, you know, diversification is very, very important and very, very powerful. But what I really want to get across here with this video is you can do a lot of different things with building a portfolio. You don't have to be as aggressive as I was here with these examples. You could take 25 stocks and you could pick your 5 or 10 favorites and put, say, half your money in that, and then spread the other half over another 15 or 20 stocks. There's just literally, as your imagination needs to be your guide here. There's all kinds of ways you could build a portfolio. You can, you know, have certain stocks that you can overweight, where you might want to put 10% position in. Other stocks you might only want to put 5% positions in. You know, there's so many ways you can do this. You can mix high-yielding stocks with growth stocks if you wanted to get income on your portfolio. So the moral of the story is there is no one-size-fits-all, and there is no perfect answer as to how, you know, you would construct a portfolio. It really comes down to, again, understanding your tolerance for risk, and also, I believe, how much time you're willing to put in to actually managing your portfolio. If you did have a portfolio of these 5 growth stocks like I, you know, talked about here, and then half the money in the S&P, you could watch these companies very easily. It doesn't take a lot of time and effort to, you know, keep up with 5 stocks. But I also want to point something out. That's easier said than done. You know, when you look at these stocks, you can see a lot of volatility. Like, for example, if you look at Ulta Beauty here, you can see a whole lot of volatility. You know, times where the stock price, you know, had huge swings. You know, here's a 33% swing in less than a year in terms of drop. You know, the stock dropped by 30%. And then, of course, you get this other period of time here where the stock would have, you know, increased by 71%, you know, capital appreciation. But then, you know, when you came into kind of COVID, then you would follow that with, you know, a 50% drop, you know, after that. So the point is, what I've said here is a lot easier said than done. Even if you had the foresight to have identified these 5 stocks in advance, which, you know, again, I'm telling you I didn't. Okay, I didn't do this, but the point is I wanted just you to see the impact of how powerful something like this could be. And then you were able to keep up with these companies. If you were focusing on the operating results of the business over worrying about the stock price volatility, you'd have seen that, you know, these companies had really good operating histories. You know, Tencent grew earnings consistently year after year, had an occasional flat year, but generally grew the business, you know, very well. Netflix has been a tremendous grower. Now, I believe it's been perennially overvalued. I would have probably never actually bought Netflix. I might have been, you know, interested in Netflix, you know, back here during time where, you know, August of 2012, where I could have bought it at a PE that was reasonably consistent with its growth rate. But I do want to tell you that I probably would have never bought Netflix. But had I bought it, and bought it even at those good valuations, I could have made 61% annualized rates of return owning this stock over that time frame, even considering the fact it's overvalued. But the point is, if I'm focusing on the earnings of the company, I would have a much better chance of holding on to these stocks than I would if I was looking at the volatile stock price. I want to point that out. And then you got a name like Lithium Motors, a tremendous growth stock that always trades at a discounted PE. That's the blue line on the graph. So what I'm suggesting here is a lot trickier than I perhaps made it seem to you, but the point is you can let your imagination be your guide. There is no rule. You don't have to say, I've got to have 50 stocks, or I've got to own 100 stocks, or I've got to own 500 stocks, even like the S&P 500. My argument is try to design a portfolio that meets your own goals and objectives that you could be comfortable owning and would be willing to spend a little time, keeping up with the stocks you own. As I pointed out, I consider the S&P 500 very overvalued. I would not recommend investing in an index today, although I would have said I would have been okay with doing it, back here when the market was trading at a discount, like in 2011, even all the way through 2013. You could have bought the index at very attractive valuation. In fact, you can go back even further and go all the way back to 2010, and you had good valuations. Even these valuations up here are not just crazy, compared to what we see today. So I wouldn't buy an index today because it's overvalued. If I was dollar cost average, that might be another thing. But in the meantime, all I wanted to get across here is that building a portfolio and constructing a portfolio is about, using your imagination. There are thousands of options that you could apply. You've got to find one that you like, one you're comfortable with, one you can live with. And I do believe in buying and holding over the long run. I don't think day trading makes a lot of sense. Most people either don't have the time or certainly the psychology to be able to deal with, very active trading. But you buy good companies, hold them for the long run, diversify properly, and, you can build a portfolio that's going to meet your goals and objectives and get the job done for you. I hope you enjoyed this video as much as I enjoyed presenting it. If you did, give me a like, thumbs up, ring the bell. And if you haven't already, then subscribe to my channel. I'd appreciate it. Thanks for watching, and I'll be talking to you again very soon. Tomorrow's Tuesday, and I'll be doing my subscriber request series video tomorrow. Thanks again, and I want to thank HeroDax for the inspiration for this video. Thanks.